right. So the proper question to ask is, what is the best investment, commercial investment for me, and what is the best portfolio for me? Now, the basis for what is the best strategy for me? The basis for asking those three questions is this: for every every individual needs to have a customized investment portfolio, investment strategy, and investments. Now, portfolio is like a mix of different type of investment that you should have. Now, what would determine the best investment for you? Let me quickly say there are three factors that will determine the best investment portfolio for you. Number one, your age is key. Now, if you are today, if you are 55, 60, you are close to retirement. So what it means is that the best type of investment for you are the investments that can guarantee that you will continue to have cash flow all the time. Now, if you are in your 20s, if you are in your 30s, particularly early 30s, and you do not have family at that time, you can afford to take a bit more risk. What you may be looking for, depending on what your goal is to say, I want to build my net worth from where it is, no matter where it is. I want to be worth about 100 million. I want to be worth about 250 million. I want to be worth about 1 billion in the next 10 years. That can be your goal. If you are somewhere in the 40s, you know that you are trying to build your retirement portfolio. You have a significant need for cash flow because you're supporting your family. You want asset that can actually give you a bit of cash flow and can also increase in value. So those are the things that determine what kind of portfolio that you have. So that is the basic concept that is discussed broadly under what we call asset allocation. So if you're asking yourself, I'm 25, I can take more risk, I'm very bullish, I can tolerate risk, I have enough time on my hand. So you want to ask yourself, so what asset should there's a slide I would want everybody to look at. Unfortunately, it's not available. The slides for this presentation will be made available to us. Now, so you're saying that, oh, I have so much time, I'm very bullish, I can take more risk, and I really know that even if I lose some part of this investment, because the higher the return most of the time, the higher the risk that the portfolio would have. That is why you need to balance that out. So if you're in that category, you want to actually look at assets that can provide significant appreciation in terms of value, that can provide or may not even provide significant cash flow as at that time, because you can now reinvest the cash flow so you can multiply the value using the power of compound interest. And if you're somewhere in the middle, you just want to balance it, you want a bit of cash, you want a bit of capital appreciation, you don't want too much of risk. So what you will do is to invest in assets that fit in that category. Because we have different scenarios, we are at different stages in our lives, we have different risk appetite. That is why the major question to ask is not what is the best investment, but what is the best investment for me based on the scenarios of my life. Most people never ask that question, which is why you find out that one person, somebody who's close to retirement will just decide, oh, I want there's an advert for a land in Shogutedo, there's an advert for a land in Mowe, there's an advert for a land in Ibafu, and then they put all their retirement savings into that. Maybe they got gratuity from office, and then they are leaving their job next year. They put the cash inside that particular investment, and then a year later, when they're out of job, when they're retired, they need cash to actually fund their lifestyle. And that's why you find them saying, look, I want to dispose the land I bought last year. Sometimes they may even have to dispose it at a discount. That is why it is important to understand what exactly would the place along the investment journey today before you make that consideration. Now, because we're not able to see the slide, I would have wanted to show you the issue why most people don't pay attention to it, which is why you see, I've seen middle-aged people, I've seen 40-something-year-old who will come to me and say, I want to invest in cryptocurrency. I want to invest in Forex because they think that their return profile is good. But what they don't understand is they don't understand their own goal. They don't understand their risk appetite. In fact, it may not even be something as esoteric as cryptocurrency. Some people say, oh, the Nigerian stock market is going up, I quickly want to put my money there. And then they put in their money when the market is at the peak of it. They put in at 1,000 and they notice that, oh, I put in at 1,000 yesterday. Today, the same stock that I bought for 1,000 is now selling for 950, selling for 900. By the time it hits 800, 700, 800, they quickly sell because they want to cut their losses. Those are the scenarios that we see today. If you are one of those people, it's time to actually have a sit and ask yourself, what exactly is my goal? What is my risk tolerance? Because if you are investing in instruments that carry some element of risk, you are one person that should be able to say, look, I want to keep this for this time. So even if, relatively the value seems to be going down, because you understand the game you're playing, you know that it's not yet time to get out of the market. Let me digress by quickly saying this, that one of the mistakes that we also make when we're investing is to invest without understanding the power of time in the value of investment we do. So we just invest, and then 2-3 days later we're in a hurry to put it out. That applies across all the investment. The reason why people don't talk about asset allocation is because it's not a tantalizing topic. It requires discipline. It requires consistency. What do I mean by discipline? If, for example, you say, look, security is the most important part, followed by cash flow. It means every asset you put into your portfolio will be secured, cannot lose value relatively. So what are those assets that you're going to put inside your portfolio on the secure box? I'm still going to teach us how portfolio is created. Portfolio is created just like a house. The house will have a foundation, the house will have the walls, and then the house will have the roof. Now, the foundation is the most important part of any building at the moment. That's the most important. If the foundation is not correct, your building will come crashing down. So what are those instruments that you should put into that basket? There are instruments that you can guarantee that they will not disappear. They carry as little risk as possible. So if you are let's say you are in your 40s, you don't like too much of risk. You want the least of all the risk because you cannot afford to lose your money. Where you put 60 to 70% of your portfolio may want to reside in your security bucket. Those are the assets you buy that you can guarantee that will not lose out. What are those assets that you can put in that category? You want fixed income instruments. You want to invest in bonds. You want to invest in treasury bills. You want to invest in fixed deposits. One of the other things that I usually tell people to invest in this category is real estate, particularly rent yielding real estate in designated area where you can guarantee relatively that you will get the occupancy is very high. So examples will be, if you are going to invest, particularly if you are liquid, or maybe you are exiting your workplace and you are going to get gratuity, you can put some of these instruments in federal government bonds. Is available in the market. If you invest, any of your investment advisor, the going to advise you, you can actually decide, I want a bit of property, depending on what your budget is. But let me quickly say that I'm sure Topper will be talking about some of the options that you may have if you fall into that category. You may say, okay, I don't have 100 million to buy this house or that house, but I want to do 10, 11 million because I want to guarantee the rent. I think we have an offering for shops that you can say, oh, I want to invest in. I lock up one shop and then I can rent it because it's located in market, and you can guarantee your rent for 5 years. I think the average rent for 5 years about 5 or 6 million. What it means is that if you do a long lease, you've collected 1 million every year for the next 5 years. You can see that. So whatever happens, that is the security bucket. The house is there to not disappear. The cash is already collected upfront in 5 years. So even though you're collecting 5 million for 5 years or even 4 million for 5 years, now it means the actual value is more because there's something called time value of money. So if you are those who do not want to take any risk, you have zero risk tolerance, you want to actually focus 60 to 70% of your asset in the security bucket. What are those things you put there? I'll repeat again. Fixed deposit. You want to do fixed income instrument like the federal government bond, and you want to buy real estate. Now, one of the questions that somebody posed to me when I was having this conversation before the webinar, and the person says that, look, all these assets that we're talking about is in Naira. What exactly can I do? Because I also want to protect myself against the valuation. So you could actually even do the federal government bonds can be issued in dollar. They call it Euro bond. It's not because it's coming from Europe. Any bond that a sovereign government is offering that is offered in another country's currency is referred to as Euro bond. So Nigerian government have Euro bond that is on offer. That's for as long as 10-20 year bond. And the rate will fluctuate between 5 to 12, 13, 14% return. So you can invest, they are usually minimum investment ticket. So if you cannot afford that minimum investment, you want to approach mutual funds that invest in a Eurobond. Those ones can actually allow you to invest smaller amounts in those kind of dollar-denominated instruments. So it's a fixed income instrument that you can invest in. It's in dollar, it's guaranteed, and it's secured because it's backed by the might and power of the federal government. So you can quickly do that. And you can actually invest in mutual fund with as low as less than $100 or $50, depending. So you can go online and take dollar-based mutual fund or mutual funds that are focused on bonds, federal government bond or Eurobond. You will see quite a number of options. The other thing is, if you're worried about devaluation too, that you could invest in is real estate. Real estate has proven over time. There, I'm not going to follow the sequence of the slide, so I will just speak extempo. I already mentioned Eurobond. I mentioned real estate. Real estate has the power to actually keep up with the pace. If you look at it today, properties or land that was sold about 2-3 years ago for 10 million, today is going for as high as 30 million, 40 million or more in some instances, depending on the area. Today is not a real estate investment related conversation. I would have been able to take us through the areas. How do you identify the area that has potential for multiple growth? How do you identify the areas that has potential for just stabilized kind of growth? But that is outside the scope of this conversation. But the summary of this is real estate has the power to edge against inflation and to edge against devaluation because it keeps up with the power of the dollar. So that is why that you were selling last year for 50 million. And we've demonstrated it in some of our projects. There are projects we sold in 2021, 2022 for 47, 50 million. Today, those same properties are going for 140, 150, 160. So that is why you want to have a real estate in your security bucket if you are risk averse. If you are somewhere in the middle, maybe you're middle age, you need cash flow, but at the same time, you still want some level of growth because you have at least a decade or two for investment. You still have some tolerance for error. You want to actually invest in instruments that can grow, but can also provide a bit of cash flow. What are those instruments that can actually grow? Equities or stock is one of those instruments you want to do if you're in this category. Remember, we're saying that it depends. So for growth related, for the growth bucket, which is the wall of the house, there's some higher level of risk compared to those who are just in the secure bucket or secure the foundation part of it. But the risk is not as high as those who want significant multiplication. So what are those assets that you should be thinking about? You also would want to think here. You want to do stocks. You want to participate in the equities market. But let me quickly say this. Before you go to the equities market, you need to understand the dynamics of equity market. You need to be learned. You need to know to be able to make decisions. But preferably, if you cannot do all those, there are professional fund managers that you can deposit your money on. I know some mutual funds that are focused on stocks. Now, this mutual fund can boast of 22, 23, 24, 25% return on investment over the last 1 year. In fact, there is a portfolio that's grown by more than 50 or 60% over the last 1 year because they are focused on equities market. Equities or stock market is one of those instruments that you want to invest in. This time they keep pace. There are three basic instruments that would help you to edge against devaluation and inflation and instability and a volatile economic environment. One of them is stock or equities. The second one is commodities. The third one is the real estate. So inside your growth bucket, like I said, it comes with a higher level of risk. You want to do stock. You want to do bonds that have a higher interest yield. For stock, it will keep pace even if there's relative loss in the value of Naira. Over the long term, over the medium term, it's going to keep pace with that. Real estate would also fall into this category. This is where you want to actually invest in land. This is where you want to buy land at 30 because you know that if you hold it for another 1 or 2 years, you can sell it at 60. It comes with its own risk because of the illiquidity. It means that it may not necessarily translate to cash on the immediate. So you need to know what you're doing. So real estate will fall into this category.